Hey everyone, welcome back for another deep dive. Today we're taking a look at the history of interest rates.
It's a pretty fascinating journey.
Yeah, we'll be going all the way back to ancient times.
Right, back to the beginning. Well, pretty close at least.
Well, we've got a lot to cover.
We do.
So where should we begin?
Well, let's start by setting the stage.
Okay.
We've got a whole stack of sources here.
Yeah, a lot of great stuff. Historical records, economic analyses, you name it.
Right, and what we're trying to do today is, well, to paint a complete picture of how interest rates have shaped the world.
Okay.
And not just from a purely economic standpoint.
Right.
We'll also be looking at the philosophical and social implications.
Oh, that's going to be interesting.
Yeah. So, for instance, did you know that even the earliest civilizations had complex rules about interest?
Really? Like way back in ancient times?
Yeah. I mean, take the Code of Hammurabi, for example.
Okay.
It dates back to around 1750 BC.
Why?
And a significant portion of it is devoted to regulating interest rates.
No kidding. So what kind of rules are we talking about here?
Well, they had barley.
Barley. I mean, I know it's a grain, but as currency.
Yeah, it was used as a form of payment back then. So the code set maximum interest rates, 20% for silver and 33.33% for barley loans.
Huh. So even back then, they were trying to keep things fair, or at least trying to control how much people could profit from lending.
Exactly. But here's the thing. Even with these regulations in place, people still found ways to game the system.
Oh, I bet. Human nature, right? Always looking for a loophole.
Well, yeah, in this case, the code didn't specify a time period for those rates. So lenders could apply that maximum rate to really short periods, like a month.
No, sneaky. So that would mean the annual interest rate could end up being way higher than what the code intended.
Exactly. And this is what we call regulatory arbitrage.
Regulatory what?
Arbitrage.
Okay.
It basically means finding ways to profit from inconsistencies in regulations. Ah, okay. So kind of like bending the rules without technically breaking them.
Right.
And I bet that kind of thing still happens today, just in more complicated ways, huh?
All the time. It's a constant cat and mouse game between regulators and those who are always looking for an edge.
I guess some things never change. But going back to ancient Babylon, those high interest rates, wouldn't that have made it really tough for some people to borrow money?
Well, it depends. Historical records actually show that interest rates fluctuated quite a bit back then.
Oh, really?
Yeah. Sometimes they were as low as 5%,
Yeah.
and other times as high as 240%.
240%. That's insane.
Yeah, it sounds crazy. But those higher rates often acted as what we call risk premiums.
Risk premiums.
Yeah, they were basically a way to compensate lenders for taking on more risk. Like if you were financing a trading expedition across the desert.
Okay.
Well, there was a good chance you might not see your money again. So lenders would charge a higher rate to offset that risk.
Makes sense. Higher risk, higher reward, right?
So it seems like even thousands of years ago, interest rates weren't just arbitrary numbers. They reflected the realities of the economy.
Absolutely. They were a product of supply and demand, just like any other price. But here's where things get really interesting. While we often think of interest rates in purely economic terms, they've also been a subject of intense moral and philosophical debate throughout history.
Oh, yeah, I've heard about that. Didn't some of the ancient Greek philosophers have strong opinions about interest?
They did. I mean, Aristotle, for example, he was totally against interest. He believed it was unnatural for money to beget money.
Okay.
He argued that interest was a form of exploitation, that money itself shouldn't be a source of profit.
So he saw it as a kind of moral hazard, maybe? Profiting from something that wasn't really productive?
Exactly. He thought true wealth came from productive activities like farming or craftsmanship, not just lending money and collecting interest.
Yeah, that makes sense. And weren't there other thinkers who share that view?
Oh, absolutely. Plato and Demosthenes, for example, they also criticized interest, especially the way it could create social divisions and resentment.
Yeah, like the haves and the have-nots.
Right. And those arguments, even though they're from ancient times, they still resonate today.
They do. I mean, just think about all the debates we have now about predatory lending practices.
Right.
Like those payday loan places that charge exorbitant interest rates.
Yeah.
Often to people who can least afford it.
It raises the question of whether certain forms of lending are inherently unethical, whether they cross a line and become exploitative.
Yeah, those are tough questions. So we've seen how people have been grappling with the ethics of interest rates for centuries.
Yeah.
But as we move into the era of merchant capitalism and the Italian Renaissance, we see a pretty big shift in how interest is perceived, right?
Right. A great example of this shift is the story of Francesco da Tini.
Okay.
He was a successful Italian merchant in the late 1300s.
Got it.
And Dattini, he wasn't just a banker. He was involved in all sorts of businesses, textiles, banking, you name it. And his success was heavily reliant on, you guessed it, credit.
So for Dattini, time really was money. And interest was the price you paid for using someone else's money for a certain period.
Exactly. And this was a time of rapid economic expansion. The world was changing quickly. New trade routes were opening up.
Yeah.
And in this environment, time became incredibly valuable.
Yeah, I can see that.
And the cost of that time, well, that was reflected in interest rates.
Yeah.
And this was a far cry from that ancient Greek view of money as a static entity.
Right.
For Dattini and other merchants, interest wasn't inherently evil. It was a necessary tool for doing business.
A tool for facilitating trade, investment, and growth.
Yeah.
It's fascinating how our views on something like interest can change so much depending on the context.
Yeah. It really highlights how perceptions are often tied to the dominant economic system.
And the balance of power between lenders and borrowers.
Exactly. And the shift in thinking was further supported by thinkers like Hugo Grotius and John Locke.
Oh, yeah, I've heard those names.
Yeah. They came along later and they argued for what they called a natural rate of interest.
The natural rate.
Yeah. They believed that interest rates shouldn't be set arbitrarily by governments or religious authorities,
Okay.
but that they should be determined by market forces, by supply and demand.
So a kind of free market approach to interest rates.
Exactly. And they argued that attempts to suppress interest rates below this natural level would actually be harmful to economic development.
Interesting. So that laid the groundwork for a lot of modern economic thought on interest rates.
It did. But it also set the stage for some spectacular crashes and burn.
Oh, is that where we're headed next?
Yeah.
I think I'm starting to see a pattern here.
You might be onto something.
Well, I guess we'll have to dive into that in our next installment.
Stay tuned. It's going to be a wild ride.
All right. We'll be back soon. See you then.
See ya. It's like trying to control a river. You might be able to dam it up for a while,
Right.
but eventually that water's going to find a way to break through.
Yeah. And probably cause a lot of damage along the way.
Exactly. And speaking of things breaking through, let's talk about bubbles.
Ooh, yeah. Bubbles. I think I remember reading about one involving a company in a river somewhere.
You're thinking of the Mississippi bubble.
Yeah, that's the one. Okay, remind me. What was that all about again?
Well, picture this. France in the early 1700s.
Okay.
The economy is struggling, and this ambitious Scottish financier named John Law arrives with a bold plan.
Okay.
He convinces the French government to create a national bank, issue paper money, and launch this company called the Mississippi Company.
Okay.
And this company was granted a monopoly over trade with the French colony of Louisiana.
Monopoly.
Mm.
That sounds, well, pretty powerful.
It did, and it was all based on this promise of incredible riches.
Riches
Yeah.
from Louisiana.
Yeah. A lot of people believe that Louisiana was this land overflowing with gold and all sorts of valuable resources.
Oh, so it's kind of like a get-rich-quick scheme, like those gold rushes you hear about.
Yeah, in a way. But there was also this idea that the Mississippi Company would help to revitalize the French economy.
Okay, so what went wrong? Did they just overpromise and underdeliver?
It's more complicated than that. You see, Law's scheme, while it was certainly innovative,
Yeah.
it relied heavily on speculation.
Speculation.
Yeah, people were buying shares of the Mississippi Company not because they necessarily believed in its long-term prospects,
Okay.
but because they thought they could sell those shares for a higher price later on.
Oh, so it was a bit of a gamble, hoping to get in early and then cash out before things went south.
Exactly. And to make matters worse, a lot of people were buying these shares with borrowed money.
Oh, boy. That never ends well.
No, it doesn't. And as more and more people jumped on the bandwagon, the price of the shares just kept going up and up and up.
Creating a bubble.
Exactly. It became this self-fulfilling prophecy. People saw the price rising and they thought, I got to get in on this before I miss out. It was classic FOMO, fear of missing out.
Yeah, I've definitely felt that myself, even with smaller investments.
It's a powerful psychological force. And there are even stories from that time about servants becoming overnight millionaires.
Really? Just from buying these shares?
Yeah. But then just as quickly, they lost everything when the bubble burst.
Oh, that's heartbreaking. But it does sound eerily familiar, like those stories you hear about the dot-com bubble in the late 90s, or even the recent surge in cryptocurrency prices.
It's a pattern that repeats itself throughout history. Irrational exuberance, driven by easy credit, speculation, and this belief that the good times will never end.
And then inevitably, reality sets in.
Right. And in the case of the Mississippi Company, the collapse was swift and brutal.
Oh, I bet. What happened?
Well, as soon as people started to realize that the company's prospects weren't as rosy as they had been led to believe,
Okay.
well, they started selling their shares, and the price plummeted.
So the whole thing just unraveled.
Yeah. It sent shockwaves through the French economy,
Oh.
and John Law, who had been hailed as this financial genius,
Yeah.
well, he became a scapegoat for the whole disaster.
I guess that's the risk you take when you promise people easy riches, huh?
It is. And the Mississippi bubble serves as a cautionary tale about the dangers of speculation, the perils of easy credit, and the potential downsides of trying to engineer economic prosperity through artificial means.
Right. So it's not just about the numbers. It's about human psychology, about greed, fear, and the allure of getting rich quick.
It's about all of those things. And those same forces are still at play today, even if the players and the costumes have changed.
That's a sobering thought. So, how do we avoid falling into those same traps? How do we learn from the mistakes of the past?
Well, that's a question that economists and policymakers have been grappling with for centuries. And it's one that will continue to challenge us as we navigate the complexities of the modern financial world.
Yeah. Because as we've seen, interest rates aren't just some abstract economic concept.
No, they're not.
They have real-world consequences for individuals, for businesses, and for entire economies. And understanding the history of interest rates, both the good and the bad, is essential if we want to make informed decisions about the future.
I think it's safe to say that interest rates have played a pretty significant role in shaping the world as we know it.
Yeah. From ancient Mesopotamia to modern-day Wall Street, the story of interest rates is a story of human ingenuity, ambition, greed, and the never-ending quest for profit.
And it's a story that's still being written. The era of ultra-low interest rates, I think it's coming to an end.
Really? Wow. Why? What makes you say that?
Well, I think we're reaching a point where those unintended consequences, like those zombie companies we talked about, and inflated asset prices and, growing inequality, it's becoming too much to ignore.
So you're saying that those low rates, while they might seem helpful on the surface, they've actually created a whole bunch of hidden problems.
Exactly. Think of it this way. Low interest rates have been kind of like a painkiller for the global economy.
Oh, a painkiller, how so?
Well, they've been masking the underlying issues, providing temporary relief.
I see.
But as with any painkiller, eventually the side effects start to outweigh the benefits.
Yeah.
And you have to wean yourself off of it.
Okay, and weaning ourselves off those low rates, that's what's making a lot of people nervous, right?
Right.
What happens when interest rates start to climb?
Well, a few things.
Yeah.
For one thing, borrowing becomes more expensive.
Right, makes sense.
Businesses will be more hesitant to take on new debt.
Okay.
And consumers might find it harder to afford, say, big purchases.
Like a house or a car.
Exactly.
So less keeping up with the Joneses. Maybe that's a good thing.
Maybe. But on a larger scale, well, it could mean slower economic growth overall.
Because borrowing and spending will decrease.
Right. And it puts central banks in a tough spot.
Okay.
They have to try and find that sweet spot.
Yeah.
Raising rates too quickly could trigger a recession.
Right.
But keeping them too low for too long just exacerbates those distortions we've been talking about.
So they're walking a tightrope.
They are. And it's not just central banks either.
Yeah.
Governments also have a role to play.
Okay, how so?
Well, a lot of governments have racked up massive debts, partly due to those low interest rates.
Right.
And as rates rise, well, servicing that debt becomes more and more expensive.
Okay.
And that can lead to austerity measures or even, in some cases, sovereign debt crises.
It sounds like a pretty precarious situation. Like we've been pulling out blocks from a giant Jenga tower without thinking about the consequences.
Yeah, I like that analogy.
And now it's starting to wobble. So what's the solution? I mean, is there a way to navigate this transition smoothly?
Honestly, there's no easy answer. But history shows us that these periods of economic upheaval, well, they can also be times of great innovation and adaptation.
Oh, like necessity is the mother of invention.
Exactly. It forces us to rethink our assumptions, to come up with new solutions.
Maybe it's not all doom and gloom. Could this be an opportunity for positive change?
I think it could be. We have a chance to find more sustainable ways to grow and to address those fundamental issues that have been papered over by low interest rates for so long.
Wow. Okay, well, we've covered a lot of ground today, from ancient Babylon to modern-day anxiety.
We have.
So to wrap things up, what are some key takeaways for our listeners?
I think the biggest one is that interest rates, even though they might seem kind of abstract and technical,
Yeah,
they have a huge impact on our lives
sure.
and on the global economy as a whole.
Absolutely.
Sure.
And also, that those low rates, while they might seem tempting,
Yeah.
they often come with hidden risks
Mm-hmm.
and unintended consequences that can come back to bite us later.
Exactly. And I think it also highlights the importance of understanding history.
Yeah, history repeats itself.
It does. And critical thinking. We need to be able to see through the hype and question the assumptions that are often presented to us as, like, unquestionable truths.
Well said. So, to our listeners out there, we leave you with this. How will you prepare for a world of potentially higher interest rates?
Yeah.
What choices will you make to ensure your financial well-being in this evolving landscape?
Keep learning, keep questioning, and most importantly, keep adapting.
And until next time, stay curious.